ISG call entitled Volatility in Context. I am Howard Coleman, Coldstream's Chief Investment Officer. On the call with me is Rich Merrifield, a member of ISG who is on Joe Cervantes' team and runs Coldstream's 401k program. The call will have 4 components. First, I will look at the fundamentals of the U.S. economy. We look at this first because, especially in times of market volatility, we need to look past the noise and focus on what moves markets other than over the very short term. We focus on economic fundamentals because since 1946, there have been only 2 instances of a bear market without an accompanying recession. By the way, we define a bear market as a more than 20% decline in the S&P. The 2 instances where we had a bear market without an accompanying recession occurred in a short bear market back in 1966, when the Fed tightened unexpectedly in the face of growing inflation, and our gold reserves, if you recall the US dollar was gold backed at the time, began to get depleted. The second the second bear market without a recession was the 1987 market meltdown. Other than those one-off events, every other bear market has been accompanied by a recession. And as you will see from the first part of our presentation, at present at least, there is no recession in sight. The second part of the presentation will focus on what is causing this market volatility. While we don't see a bear market in our near future, we do see the strong potential for this volatility to continue for a while. We will analyze the factors that contribute to this volatility. Finally, Rich Merrifield will then present a few charts showing where we are in the markets technically. While we are not technicians at Coldstream, technical analysis does give us guideposts that we use to factor into our market analysis. Finally, please use the question box on your desktop or mobile phone if you would like to ask a question. I can't promise we'll get to it on this call, but we will try. And if you were not able to get your call answered on this question, please contact your relationship manager or portfolio manager with your question, and we will get it answered. So now let's turn to the first slide in economic fundamentals. As you can see on the screen, this is real GDP. And real GDP was recently adjusted upward for the second quarter. Annualized growth for the first half of the year is now 2.2%. It was previously estimated at 1.5%. Also, initially, if you'll recall, the first quarter was initially estimated to have negative growth, and it now had 0.07% growth. So the GDP figures, while not spectacular, continue to show good, steady growth. The Conference Board puts together leading economic indicators. Economic indicators are generally either leading, coincident, or lagging. Leading means they have some predictive powers. And the leading economic indicators, the ones that have predictive powers, continue to show good growth in the U.S. economy. Initial jobless claims are declining as well, and this is a good thing. In fact, they're declining even below what most of the surveys have indicated recently. Here you can see initial job claims continuing to decline. Employment in other respects continues to be solid. The civilian unemployment rate continues to fall, and the total number of non-farm employees continues to rise. This is a very important metric that the Fed uses in deciding whether to raise rates or not. It's one of their 2 mandates, employment and inflation. Industrial production, this chart may not be the perfect chart to show it, but continues to be strong. The PMI number, the Purchase and Manufacturing Index number, continues to be over 50, which shows growth. Consumer confidence, another leading economic indicator, continues apace and continues to get strong. Perhaps the biggest strength in the economy right now is housing. And as you can see from this chart, housing starts are continuing to improve. Now, the really good thing about this chart is if you look at 2005, 2006, and 2007, we're nowhere near the 2005, 2006 levels. So not only are we improving, but new housing starts have the potential to continue to improve significantly as household formations are starting to increase again. U.S. existing home sales are also rising. So although this does not increase the housing stock, it does show that there is activity in the housing market that's continuing to progress. Case-Shiller Home Appreciation Index. This governs how much prices increase year over year. And as you can see, we're having a 4.55% increase in housing prices this year. Now, of course, for those of us in Seattle, we would love only a 4.55% housing increase. Seattle is much more, but this is nationwide, and it's continuing to show a strong housing market. One of the things that was a difficulty after 2008 was that the government's fiscal policy created a drag on the economy because we were cutting spending. This is changing, and receipts are growing and outlays are growing, and this should be a further wind on the U.S. economy's back. And the credit environment, and when I say the credit environment here, I'm talking about households' credit environment. I'm not talking about the government's credit environment, which is a very different issue. But the household credit environment looks very, very good. Households in this country have dramatically deleveraged since 2008, which shows that there is purchasing power stored up by the U.S. consumer. So those are really most of the key economic fundamentals. None of them show we're heading into a recession. They show steady continuing growth, and those typically are not the predecessors to a bear market. Now, we talked about volatility and why the volatility will continue to increase. And now we're going to talk about that for a few minutes. The Fed has a dual mandate, employment and inflation. And the employment mandate is to try to create full employment, and we are actually very close to that number. The inflation mandate has historically been to keep inflation under control, but right now it's trying to generate some inflation, and the Fed's goal is to have a 2% inflation target. We're not near that. You may be most familiar with the CPI as the measure of inflation, but the Fed actually uses something very similar, but it's called the Personal Consumption Expenditure Index, the PCE. And as you can see, the PCE, which excluding food and energy, this is core PCE, is below 1.4%, hovering around 1.2%. And if you exclude housing from that core PCE, we're at about 0.6%. Wage inflation, which earlier this year we were thinking, oh boy, wage inflation is coming back, this is a good sign, has tailed off recently. And thus, the great debate as to what the Fed will do, because their two mandates are telling them very different things. Their employment mandate says raise, their inflation mandate says you can't raise right now. The other thing that can contribute to volatility is dollar strengthening. Now, dollar strengthening has a complicated effect. On the one hand, dollar strengthening from a negative point of view is deflationary because goods become cheaper and it becomes harder to generate inflation. It also hurts significantly corporate profits abroad. However, as we all know, when gas prices go down, it gives more money into the consumer's pocket and creates the potential for additional consumer spending. But the Fed is concerned about the increasing strength of the dollar for their deflationary mandate and for corporate profits abroad. There is a very, very strong correlation between the price of commodities and the dollar strengthening. And those of you who have followed commodities know that commodities have been in fundamental decline recently, which is also something that can create volatility in the same way that the dollar can. It is deflationary, but at the same time, we all enjoy a lower price of gasoline. In addition to the dollar hurting commodities, China is a fundamental issue that will probably cause continuing volatility. China's manufacturing PMI is now below 50, which is in a declining mode. China's share of global GDP is significant, and its share of total petroleum consumption is also significant. But when you look at commodities such as copper and iron ore, the share of China's purchases in the world market is remarkable, and we've seen dramatic declines in those two metals and metals generally recently. Now, the good thing for the US is, unlike Germany and other European countries, our export share of GDP to emerging markets is relatively low, 3.4%. You compare that to Germany at 12.7%, and the Euro area in general at 9.2%. So we luckily are less affected by China and the difficulties in the emerging markets than others are. But it has had an impact, the decline in commodities, and you see it very much in corporate earnings. If you'll see the S&P right here, corporate earnings through June 30th have been minus 4.5%. This chart was prepared in July, and it was a little bit better at minus 2.2%. But with energy, you see energy companies with dramatic declines in earnings. And of course, that hurts the S&P corporate earnings overall. And this, even apart from the energy sector, we have some difficulties in corporate earnings from utilities, materials, again, copper and those things, telecom services, and even a little bit in consumer staples. So this creates another interesting item to follow going forward, is the impact on corporate earnings. And this will continue to create the volatility that we're seeing going forward. So in sum, from the two factors that I'm going to address, we don't see a bear market. The core basis of the US economy continues to go along well. We have a difficulty generating inflation, we have EM concerns, and we have some corporate earning concerns that we think may make for a volatile environment. So hold on to your hat, but we don't think the world is falling apart. And now I'm going to turn it over to my colleague, Rich Merrifield.
Hello, and thanks for joining us today. I'm going to speak about specifically the Standard & Poor's 500 index, the largest of the large cap stock index in the United States, and probably the most frequently traded by mainstream Americans, hedge funds, mutual funds, 401ks, and pension funds. And it's the most widely looked at, although the Dow Jones Industrials is probably the more famous of the averages. With only 30 stocks in the Dow, it's a very niche group. So we're going to focus on the S&P 500 and looking at what's really happening in the markets. But before we look at what's happening for Howard's conversation on recent activities in the last 6 to 8 weeks in the market and the increase in volatility, I'd like to step back and take a longer-term view of the S&P 500 to put recent action into perspective. So the first chart is a chart of the Standard & Poor's 500 monthly. So each of the colored bars, green being up months and red being down months, represent a long-term look back on the Standard & Poor's 500. And we're going to move on each of these charts from the left to the right. So starting on the far left side of this chart, you'll see a circle at the bottom drawn around the year 2003. And that represents the end of the tech wreck and the end of the first big dismantling of the S&P 500 after the 1990s rally rally, which ended in 1999 with a big bang, and the Nasdaq up 100% in that year. We were probably well overdue for a correction. We had that correction, and you'll notice a cyan-colored blue line that runs through this chart. That represents the 2-year moving average of price. It represents a good trend indicator when you're looking at long-term charts. And any positive action in the market can be expected to stay above that line. And as the market trend ends, you could expect that index to drop, price to drop below that line. You'll notice that quickly after the 03 tech wreck, we resumed an up rally, and that rally lasted well into 2006, 2007, where then we began a recession and began the financial crisis, or otherwise referred to as the Great Recession. You'll see the breach of that blue line, which represents the end of the trend, and then a rather sharp fall off to the 2009 lows in March of 2009, which not coincidentally ended at the exact same point as the 2003 tech wreck. And this isn't coincidental because technical analysis in moments of great volatility in the markets tends to be the driving force of market decisions and not fundamentals. Fundamentals tend to be thrown out in periods like we're experiencing now in volatility. People are more akin to trading at key inflection points in the market's behavior. So it's not unusual that buyers stepped in at this price believing that these 03 lows would not be violated. Of course, it's a chance they could have been violated, but it creates a lot of buying interest. As we came out of the 2009 crisis, we resume and take back that 2-year moving average, and we resume a rally that is tested with the Greek crisis in August of 2011. And that crisis saw the S&P 500 drop approximately 16% in less than 2.5 weeks. And you'll notice, though, that it did not violate the 2-year moving average, and traders supported the price there. And then we took off on what has been a 2.5-year to 3-year rally, albeit 2011 and 2012 were reasonably tame years in performance for the S&P, up just about 3% each year. We did see positive movement. The arrow drawing up from 2013 is the real breakout. That's where we saw the power rally in 2013, where the S&P was up more than 30%. You'll also see a white line drawn at the top. That represents the market clearing the 2007 highs, which moved the S&P into kind of record territory and further fueled the rally. You'll see the price move further and further away from the blue line. That's the sign that the rally is getting rather extended. So this is kind of a preamble into saying that after such a long rally that we've seen here, a corrective period like we're experiencing now technically would not be unexpected. You'll also notice that the current price movement is sitting right on that 2-year moving average, which is a fairly big support zone for the market. The next chart zooms us in a little closer, brings us a little closer into current times, and now each of the bars, the red and green bars, represent a weekly price action. So each represents 1 week of trading. And you'll notice again on the far left side, the arrow pointing up to 2013. And I'm emphasizing that because, again, with the white line, you'll notice that that is the point in the spring of 2013 where we broke out to new market highs in the S&P 500 and broke out of a post-recessionary period. The blue line now represents the 52-week moving average, not the 2-year moving average. So the average is shorter time frame to coincide with the chart. And you'll notice that this 1-year moving average has been very supportive of price throughout the entire rally, both 2013 and then on into 2014. Just above, about 2/3 of the way to the right of the chart, you'll notice a sell-off in October of 2014. That represents a very short and almost too short correction, lasted just about 10 days, and took the market down just shy of 10%. We quickly bounced back, and in 2015, you'll notice in the shaded box that the market really hasn't gone anywhere. The market is quite stuck. So even before the recent selling, the U.S. stock market was really flat for the year. We went up and down, and volatility increased, but we really didn't see any positive price momentum. The recent selling, as you can also see, has gone down and tested the October 2014 lows, and we bounced off of those lows. And that would be the first key area of support, would be to not break those lows. And we're watching that very closely here at Coldstream. Next chart. Finally, the third chart is the daily chart of the Standard & Poor's 500. Each of the bars represents 1 day of price action. And the blue line now, the light blue line represents the 50-day moving average of price, and the dark blue line, the 200-day moving average of price. These are the two most famous indicators in technical analysis, the 50-day and the 200-day moving average of price. The left side of the chart at the far left is starting in January, and you'll notice a very quick rally in early February, and you may remember it in the media, taking the Standard & Poor's 500 to record highs. Those record highs are represented by that top white line. But then you'll notice this congestion zone. For most of the year, we've spent ourselves waffling back and forth from the high end of the range to the low end of the range, but with very little price appreciation. And then finally, as we move into the spring of this year, you'll notice a term that says the death cross is complete. It sounds rather ominous. It's just a technical term. The death cross is an old school term that says when the 50-day moving average crosses down through the 200-day moving average of price, you have a confirmed trend reversal from an uptrend to a downtrend. And I think that we have now at Coldstream determined that that trend reversal is in place, that we, at least for the short term, have ended our uptrend that started in early 2013 or actually early 2012. Since that selling period, you'll notice some very, very big selling days. We call these gaps, where the price drops very precipitously. And then we move to the 2014 lows of October, where we have successfully bounced from those lows. We have something called a wedging pattern, where each successive rally has a higher low than the prior, but each successive selling day has a lower low than the prior, and it forms a bit of a triangle. And this is an inflection point, meaning that the market is at a point where the spring is wound up. We suspect that sometime next week we're going to see a breakout of this formation, either the upside or the downside. And our gut is probably that we're going to see more volatility and probably a retest of those October 14 lows. But in perspective of where we've come from, this is not only expected, but I think even in the month of October we could see additional volatility. So I guess the message to our clients is that this is not unusual. This is very familiar territory, long overdue. The Standard & Poor's 500 index historically has a 10% correction about every 9 to 11 months. We went about 40-plus months without a correction, so we're a little overdue for that now. And so continued volatility, as Howard Coleman was saying, should be expected into the remainder of this month and into October, and possibly a retest of those October 14 lows. So, thank you.
Thank you, Rich. I'm going to close with just two other more political events that are coming up at the end of the month that could create some additional temporary volatility. We don't think the volatility will be permanent. These are events that are not certain by any means, but I just want to mention them. The first, and we probably give this a 20% chance at best of happening, is there is an independence vote right now in the province of Catalan in Spain. The polls are showing that that vote will not pass. If it does pass, then the Catalonians, which were about 25% of Spain's GDP, seek independence. We think that will create some additional significant volatility. Short term, the other volatility that we see, and we give this about a 50-50 chance, remarkably, as we don't think it's on many people's radar screen, but we think there is a 50-50 chance of a government shutdown at the end of September over Planned Parenthood funding. We don't have the time right now to go into the politics of that, but it is very interesting, and conservative Republicans are, in the House of Representatives, are pretty firm in not carving that out from the budget resolution. And so we are going to see, whether the government shuts down or not, we are going to see some brinksmanship, we think, coming up over the next couple weeks. But again, history shows even when there is a government shutdown, we have a period of volatility, but nothing is very lasting. Anyway, we thank you for your time and your attendance. We encourage you to follow up with your portfolio manager and your relationship manager for any additional questions that you have. So thank you very much, and I appreciate it.